Hey everybody, welcome back. Monday, 11 a.m. This is where we are. So Ben Cowen and I are joined by you guys today out there in the audience, and we thank you as always for tuning in. First off, Ben, how you doing? Did you have a good weekend?
Yeah, pretty good. Pretty eventful weekend, but yeah, just hung out with the family a lot and mostly tuned out of the markets. How about you?
Yeah, it's kind of the same thing. Yeah, I paid attention to a little bit, but for the most part, we did some pool time, and yeah, man, it's at least down here in Florida, the summers. If you're outside, you're in the pool. That's for sure.
Right, for sure.
Cool.
Yeah.
All right, man. So let's dive into it. I have a couple things I want to kind of go over, and I know we usually start with crypto or something, but I'm kind of curious about the mortgage side and what information you have on the mortgage side, because one of the things that struck me, and I'll show my screen here, I have a chart, is that mortgage. The first of all, the mortgage market is dead, right? I mean,
Right.
it's case in point. I mean, here we have the lowest demand for mortgages since 1995. And you look at what's going on, and you basically have people that have bought houses. They might want to move, but if they're locked in at 3 or 4%, they're not going to buy a house for the same value and then end up paying 7 or 8% in mortgage, a mortgage rate and an interest rate. And then you have buyers who are like kind of priced out of the market. And so, it's one of those things where I'm just curious if you kind of, do you see this remedying itself? Like, what's the remedy? Is just when interest rates finally drop, it'll unfreeze the market. I mean, how are you viewing this?
Yeah, that's a good question because the real estate market, first of all, the real estate market moves like incredibly slowly
Yeah.
especially compared to things like crypto. And I mean, even the financial crisis lasted. I mean, the bear market for real estate lasted what, 4 or 5 years before it ultimately bottomed out. Uh, I have a few real estate charts that I occasionally look at. Like, here's the purchase only housing price index. It's gone on to put in new highs here. I know some of the indices that sort of track house prices, especially coming out of the Fed, have not put in new highs. So I know that it sort of depends on which one you're looking at. So there has been some resiliency here over the last few months. Even with the Zillow Home Value Index, you can see that it's kind of gone back up. I think there's a few things. I mean, I think the issue is that everyone locked in low interest rate. I mean, low mortgages, right? And so no one really wants to move. I think that the way that people do move, of course, is that they find a new job and they have to move across the country somewhere. But I think the real thing that could cause a downturn in the real estate market, that's more than just say like a little blip, right, would be a recession, right? I mean, like, that's where if you get layoffs, that's what forces people to sell. That's where you get foreclosures and whatnot. And I think right now, there still are a lot of people that have been living off all this excess liquidity from 2020 and 2021, and it's just a matter of time before that excess liquidity sort of dries up. And so I think the main thing that I would be looking for is that a recession would eventually cause the real estate market to turn back down. And then the Fed would likely cut rates at some point. But even when they cut rates, I don't think that's necessarily going to immediately lead to the bottom for the real estate market. I think that it would still take some time because, again, the Fed, when they cut rates, they normally cut too slowly for it to meaningfully have any meaningful.
Yeah, and I also wonder if the Fed cutting rates unlocks things. So right now you have a scenario where there's not much inventory out there. So you don't have people putting their houses on because they don't want to sell a house and buy another one with these levels, and then buyers can't afford it. If you actually lower interest rates, you could actually see the housing market somewhat collapse in a way, because all of a sudden people might say, yeah, I will sell my house. And then all of a sudden there's a flood of inventory on the house. Now, granted, it's not going to happen by the Fed lowering rates by 1%. I mean, it's going to take multiples. And I do think it's important, and this is the last thing I'll leave this on unless you have anything to add, because I want to keep us moving today. But I do think that this is a result specifically of the Fed raising as aggressively as they did. If you look at past cycles, the Fed has done a much slower gradual hike. Right. It's been a longer period where rates have gone up. This has been a very historically short rate. It's very vertical of how fast interest rates went up. And I think it really kind of caught people off guard. And it's a shock when you all of a sudden are in at 3% or 4%. And you're like, holy cow, my new mortgage would be 7%. That's an extra $1,000 a month. I mean, that's for many people, that's not doable.
Yeah, no one wants to move. The only reason they would move really is if they're forced to, right? New job, layoffs, something like that. By the way, here's a chart I was talking about earlier. Like, here's one coming out of the Fed where it shows you median sales prices of houses sold sort of topped out here in October of 2022, and it's mostly been trending down ever since. And by the way, Gareth, one of the things you mentioned was just inventory coming onto the market. The month to sell a new home, I think, bottomed out over here in October of 2022, September of 2022, right? That's where I think it sort of bottomed out. It has pulled back recently, but I think we could easily see it bottom out again. And you could get this series of like higher lows from like one September to another. But again, it could take like 4 to 5 years for that process to ultimately play out. So I think you're right. I think a lot of inventory would eventually come back on the market under lower interest rates.
Nice, man. Perfect. All right, I'm going to kick it to you. What do you want to discuss now, Ben?
Yeah, I mean, I think it's probably worthwhile to sort of talk about, well, there's Bitcoin, right? Bitcoin hasn't really done much of anything here in the last couple of weeks. It's kind of a similar move as to 2019 at this point, right? Where it sort of falls down here and then hesitates for a little bit and hasn't really made up its mind on what way it wants to go. Are you, I would ultimately think that we're going to see 23K in the next few months. And the reason I say that is because, just looking at like the year-to-date ROI of the Bitcoin price compared to the 2015, 2019 average, it seems reasonable that we're likely going to see 23K, 22 to 23K this September. Are you in line with that idea, or do you think it's more likely that it goes up from here? And again, even if you look at this, it doesn't mean that we can't go to 28K, put in a lower high, and then go down. But I can't hear you.
We had an alarm going off in the background here. I was trying to save everyone from hearing that. But yeah, so based on what I'm seeing in the chart, so same kind of general thing, right? We have this flag pattern starting to develop. This is what we would refer to as a bearish flag pattern. Doesn't guarantee downside. Nothing's 100% in technicals, but what it does is if you looked at 100 of these patterns, about 70 of them would continue downside. So the question then becomes, does this low hold at 25,000, which was where we got that BlackRock news? I would say ultimately the more we consolidate here, the bigger the drop. It probably pierces that at least. The question, does it go to 23,000? Now, what I actually saw your post on Twitter about this, and I was like, you know what, that's an interesting thought, because I don't have a level technically there. But what I did do is I said, let me do a Fibonacci retrace and just see what we get. And if you do a Fibonacci retrace, interestingly enough, right around 23.3 would be a 50% retrace. And I think that's what you had brought up as well, is that that would be a 50% pullback from the low to the highs right around that 23,000 level. So I do think it's going to head here. I think that you still have this very much kind of, it seems like the biggest bulls, which are the smaller investors, they're becoming very lethargic and kind of disinterested. They're kind of getting depressed in a way. And I think that creates an opportunity for a flush to wipe them out and kind of force price a little bit lower, kind of wipe out the weak hands, if you will. And so I am curious. I do think that there is some downside here.
Yeah, it's interesting because 23K isn't really a technical target just by looking at the price chart per se. But one interesting thing about that number is it's actually slightly below this prior low. So it's sort of that thing where, like, if it goes to 23K, it might get a lot of people to say, all right, it's a lower low. And then a lot of people sell into that low because they think that, all right, Bitcoin's going to capitulate immediately, only for us to get them a bounce off of that level, just to get people to come back in once again. But Gareth, have you looked at all here at how Bitcoin, I do think Bitcoin will take out this low. But what I think is really interesting is how Ether already did take out that low.
Yeah.
Right. So, this shows you, it really does show that there is some relative weakness in the market. Are you seeing the same thing here?
Yeah, 100% the same thing. So just going to my chart here, you can see here was your previous low here, which was the same low as we were just talking about on Bitcoin, and it pierced it by a wide margin. Now it has recaptured it on an intraday, on a daily basis, but I'm seeing same thing, and I'm seeing again a same thing, bearish pattern developing here. So to me, it's looking like we probably still do have some downside. Doesn't mean that we're necessarily going to go to all-time lows or not all-time lows, but 52-week lows, multi-year lows. But it certainly looks like there's a more negative tilt towards Ethereum, like in terms of dominance. There's no doubt that Ethereum is weaker, and then even weaker than Ethereum is the Polygons, the Cardanos, and et cetera, all the way down the chain. And if we just look at some of these, like our Cardano is holding support here. There's actually a big level of support, but look at where it is. It's basically back to its 52-week lows at this point. Right. And again, that's just showing from the progression. In fact, it's a great progression to think about. Bitcoin chart to Ethereum chart to like Cardano chart. and just showing how each one is closer and closer to those lows until Cardano basically is right there. And again, it just speaks to, and to understand this, people that are watching, right? It's nothing against Cardano. Ben and I are just looking at data, right? It is what it is, and it's essentially the psychology of it is that investors are at a point where, at least the bigger investors, they're not going to risk, right? It's about de-risking, and when you de-risk in the crypto markets, what do? You go to the safest play. Now, what's the safest play? It's going to be Bitcoin, and I think that's what we're seeing here.
I think it's as you go further up the risk curve, right? As you go further up the risk curve, people are going to take on less risk. But there's actually a really cool way to look at this chart. So a lot of people say, right, like that, the fundamentals of all these altcoins are super important when we're in this phase of the cycle. But Gareth, there's a really interesting chart. So look at the ROI after latest cycle peak for Cardano, Solana, Polkadot, and Avalanche. They're all at the same spot. Like they're all at the same exact level, right? And so, when I look at a chart like this, what it tells me, and it continues to tell me, and I think you would probably agree, is that, the narratives don't really matter, right? Like the sort of the great community narrative or the fundamentals of all this stuff, it doesn't really matter so much at this phase of the cycle. What's more so important is liquidity, and liquidity is drying up. But the reason why that altcoins tend to do so much better in a bull market, right? So we've seen people, right? They how many times have we heard someone call for alt season this year, Gareth? I mean, like every single week, someone's calling for alt season, and these coins just sort of keep going lower. But you see how, and I think the audience should really note here how Solana went a lot further down than these other coins. And then everyone now thinks that Solana is a lot stronger than these other coins, but in fact, it just reverted back to the mean, right? Mean reversion. So look at Bitcoin and Ether on this chart. You can see which ones are the blue chips, right? I mean, so if Bitcoin and Ether were to drop back down to say these prior lows or just somewhere around there, right? The altcoins get crushed again. But the reason why altcoins can give such great gains in a bull market is because the ones that are going to stick around and survive, right? The ones that aren't just going to become a relic of a prior cycle, in the same way that Solana closed this gap, a lot of the altcoins, let's say they come back down here, they'll close that gap back up to where Bitcoin and Ether are. So that's where those oversized gains in the altcoin market come from. It's just that most people don't realize those gains because they buy the dip in altcoins all the way down.
Right. And so at best they're getting back to break even. But I think that's what you're bringing up is such an important point, is because I think people really are like, oh, Gareth and Ben hate altcoins. No, we don't. It's just understanding the cycles and how they behave. And again, you brought up a great thing. It's like the blue chips, right? So if you're investing in Apple, that would be the equivalent in this market of Bitcoin. And then if you're investing in some no-name company, that right now is an altcoin that's trading at these multi-year lows. It doesn't mean that no-name company couldn't become the next Apple if it survives. It's just probability. So investors have to say to themselves, all right, how much money am I willing to risk on a gamble versus almost a sure thing, right? Almost a sure thing is Bitcoin, and a gamble would be an altcoin. And again, a gamble can work out really, really well. It's a gamble. Maybe you win 10x, 100x, or it can be a dud and you can blow up.
Right. It's like one of these altcoins probably will bounce back to new all-time highs, but there's a good chance that the other 3 or 4 won't. And so it's much riskier. And so a lot of people just say, well, rather than risk a lot of money on something that might just go to zero, they'll just put it into Bitcoin.
And I think what this brings up here is it's called diversification, right? And I know crypto and in general, people don't like to do it because it means that if the big thing does 100x, you don't participate in the full 100x. But at the same time, it's about preservation of capital. And for my 24 years of trading, I didn't start making real money until I started diversifying, because there's always going to be a dud. I've traded for 24 years and I still screw up, and I still have a stock that goes down 70% on me or whatever. And the only way I survived that is because I had only 3% of my portfolio in that. So it was a 2% loss in my overall big portfolio. And so just always remember that, folks. It's real money is made with diversification.
Yeah, are you sort of seeing, like, across your channels, are you sensing some level of apathy setting in? I mean, we do know that markets tend to eventually bottom on apathy. It kind of feels like I don't really think we're far enough into the apathy phase just yet, but it certainly seems like it's starting to set in. Do you feel that too?
I do, especially in crypto. I mean, stocks, there's still a lot of optimism out there,
Yeah.
even though some of these things have come off their highs. But like last week in stocks, it was just remarkable, the Nvidia hype. And I just want to show this chart, and we'll go back to the apathy in this. But so, like, just to showcase how important psychology is to a market, is that you had Nvidia coming out with unbelievable numbers. But I've been around long enough as a trader to know that when something's at an all-time high and it's gone up 400-500%, when you have those unbelievable numbers, sometimes tops are created with euphoria. And that's exactly what happened. So on those unbelievable numbers, Nvidia actually opened sharply higher, closed flat, and is now down 2 days consecutively from those earnings. So it's actually below the level that it was when they announced these amazing numbers. And so just going back to it, it's just like understanding that apathy can be a signal of maybe getting close to a bottom, while euphoria is often a signal of a top. And you have to, as a trader, like as an investor, be able to recognize and kind of step outside of your body so that you can say, hey, don't let that emotion take control of you, right? Because as soon as you get the emotion is going to get you to buy Bitcoin at 69,000. That's what markets do. They get you to do the wrong thing at the wrong time. And again, just going back to crypto markets, yeah, I think you are seeing that, compared to the hate I was getting when Bitcoin was at 31, 32,000. And I was saying, guys, I don't believe this is going to break out here. Now, I don't even hear anyone talking about it. I mean, it's minimal chatter on crypto. And I think that like you said, I don't think it's the bottom. But it reminds me of a fighter being knocked down, but not knocked out. Right. I think that's a good way of putting it.
I think one way too for like Nvidia, because we had really great numbers, right? But I think what the market probably is concerning itself with is, can they repeat those numbers next quarter and the quarter after that, right? And so that's, I kind of think, where the issue comes in. It's not that they didn't put up great numbers, they did, but the market prices things in,
That's
6 months ahead of time. And
that's
so
100% it, right? So what you have to say is things top on as good as it gets, right? So, but this is the kicker, is that smart money or institutional money knows that. The small investor gets caught up in the emotion of, oh my God, these were amazing numbers. I'm watching CNBC, or I'm watching mainstream media, or I'm watching Twitter, and I got to get in because this is such amazing. While smart money is saying, hey, this is as good as it gets. Competition's going to come for their lunch big time now. And this is probably now a story that's in the past.
it's sort of like, like, I don't know if you follow the GDP now, out of the Atlanta Fed, how they're predicting 5.9% in Q3, which is just insane, but even though their predictions have been going higher, the market has not, right? I mean, the market has sort of pulled back into that. Again, I do think part of the pullback right now in stocks is more so due to seasonality. Some people say, is this the recession being priced in, right? I don't think, at this point, I don't think a recession has been priced in. I think this is just a seasonal pullback. And I mean, if a recession gets priced in, usually with a recession, you go put in a new low, right? You don't just get like a 5% drop. So I think that we are still in that phase where, you look at like things like the Atlanta Fed, and they're predicting like almost 6% annualized for Q3. And it seems like pretty out. I mean, it's not to say that it can't happen, but it just seems like, is that going to be as good as it gets before we really have to face the sobering reality of, how hard are these interest rates going to actually hit the economy as we get out into 2024. And so I think that's some of the things people should consider, right? Sometimes you get 5% drops. Like the bigger drops come once the recession gets priced in. And I don't think that's going to happen until we start to see, things like initial claims printing in the 300Ks, right? And we're still in the 200Ks right now. But technically it's putting in higher lows, right? Initial claims are in fact putting in higher lows.
Yeah. Now, one of the things I wanted to bring to attention of everyone out there is the US dollar. There's been a lot of talk, and I'm sure you've seen this all over Twitter, is about de-dollarization and how the dollar is eventually going to be used. I mean, we had the BRICS summit last week, and one of the things I wanted to just show people, and I'd love to get your comments on this, is a chart that shows that the US dollar was used in more transactions in July than basically ever before. And so here's a chart, and this is compared to the euro. The euro is actually falling off a cliff, but look at the dollar. The dollar, again, has now been used in more transactions. It's actually had a spike higher. And so I think it's just, I look at a lot of what we get on these social media platforms, Ben, as kind of like there's a certain narrative being driven on it. to kind of like make it out like it's worse than it really is, or this, oh my God, the dollar is going to collapse, I have to buy Bitcoin or whatever. But I think it's important to recognize that this is actually telling us the opposite. Now, I still believe that over longer term periods, the dollar will be used less and less. It's just the nature of currencies to slowly kind of devolve from a status of where it is. But I mean, again, I don't know if you have any thoughts on that, but I think it's really interesting on the US dollar.
Well, from a technical perspective, the dollar is about to take out this prior high. And so it kind of shows you that, I mean, all this news hasn't really kept the dollar. I mean, I almost wonder if this is some type of, I don't know, Wyckoff accumulation on it. I don't know. I mean, it's hard to say. I mean, I know a lot of times you'll see the dollar sort of fall as you go into a recession, but it can also rally before a recession as well. It's sort of like how oil can rally into it, and then it sort of rolls over on the other side of it as people leave. But yeah, I mean, like, just from the dollar perspective, this is a significant move because we're sort of back at these highs. And so I'm curious if we do eventually, I mean, we'll see it pull back at some point. You know, I'm wondering if this will hold, and then if it goes up. See, the issue if the dollar keeps going up is that it just sucks liquidity out, right? Like it sucks liquidity out of the system, and therefore risk assets tend to go down. And so I think that's sort of the bigger issue is you could have an environment where maybe the dollar pulls back and then goes higher, sucks liquidity out of the system, and risk assets fall off a cliff as you get into, say, like 2024 or something. And then perhaps the Fed is forced to pivot and we, you know, go through QE again, and then you start to see the dollar come back down. I don't know how high it will go, but I do think there's reason to believe that the dollar could head higher, especially given, you know, we've seen a lot of bad news, but the dollar just keeps going higher, you know?
Yeah.
So,
and I think part of the bad news thing is that a lot of the bad news is globally bad, right? It's that the U.S. is still holding up, like jobs wise. Last week, jobless claims were still pretty good. They actually fell, so less people filing for unemployment. And then you look at like China and what's going on there, right? And their currency is starting. I think they actually had to prop it up against the dollar because it was starting to fall so much. And you can look at Europe, what's going on there. And so again, you know, one of the things I always say, and I think you say it too, is that the dollar is still the nicest house on a nasty block. As much debt as the US has, Japan has more, China has more, you know, like, so it's kind of like, well, where do you want, if you have to run for cover, where are you running for cover? And I still think 20 years from now, there might be a different reserve currency, but it's still 20 years from now.
Right. I mean, like, these things move in decade-long movements, right? It's not like everything's going to happen overnight. And I mean, like, initial claims, you're right. Like, they fell this past week. Yeah. I also think it's relevant to sort of show that they are putting in macro higher lows, right? And last year it bottomed also in September, right? So late September is where initial claims bottomed last year, higher low in January, higher low in July, maybe another higher low coming up here in September again. And I think the issue, Gareth, is that once this gets above 300K, then I think you're going to start to really see it impact like the unemployment rate, right?
Yeah,
I mean, like, the Fed's job has been pretty easy so far, right? Because they haven't had to worry about the labor market at all. They just keep raising and keep going through QT, and
the dual mandate sure is easy when it's only one-sided, right?
Yeah, but I mean, at some point they're going to have to weigh the other side of the equation, and they haven't had to weigh that yet. And I think they're probably going to have to start weighing that side of it probably late this year, early next year, is once it becomes more of an issue. Do you think they're you know, what are your views on their on interest rates? Do you think they can go higher? Because I was looking at the CME group, and I believe the last I looked, the expectation was another 25 basis point rate hike, not in September, but in November.
Yeah, that's what I saw too, is that potential for that. So the key here is that that's still multiple months away. So there's a fair amount of potential for that to shift. Like if we started to see a weakening labor market in the next 2 months, it's very likely that could be pushed off the board. But you're right, after they were very hawkish on Friday in Jerome Powell's speech from Jackson Hole. And I think what you take from that is twofold. So number one, the markets fell initially. All right, we saw the stock market falling when he was hawkish, which makes sense because he might have to raise interest rates. But then the markets rallied back. And what I take from that is a lot of his commentary was about how strong the economy is. And if you look at stocks, what do they need? Do they want a weak economy or a strong economy? Well, for PE expansion, price to earnings and all that, you need a strong economy. So that's actually a positive for stocks. So the worst scenario would be a weakening economy for stocks. And he's basically saying, hey guys, the economy's strong. Yeah, we have elevated inflation, but that enables us to raise because the economy is strong.
Right. Yeah. I think a lot of people have been surprised at just how hawkish that Powell has continued to be this far into the rate hiking cycle.
I have. I'll admit it. I honestly thought that by mid-year we would be done with hikes, and I honestly thought the labor market would weaken a lot sooner too. I've been somewhat caught off guard by how strong the data has stayed in the U.S. As you look at some of the money flows, and how much money was in the sloshing around in the economy, it starts to make a little more sense. But still, it has been more resilient than I thought.
Well, I mean, I thought that the Fed would reach 5 to 5.5%. And now I'm wondering, maybe I'm too conservative, I mean, because I feel like they're just taking everyone off guard. I mean, because back then, at 1 to 2%, the only reason I thought they would hit 5 to 5.5 was because I'm like, well, they need to get above where inflation is, right? Because a lot of times you'll see the interest rates go above where CPI is, core CPI, and I just figured, hey, they got to get above 5%. But now inflation is dropping, and the Fed is still talking about continuing to raise. So I think they are more hawkish than most people imagined they ever could be, and it really does show you how their reaction function changes during a period of high inflation, which is different than what we've seen over the last 40 years.
Yeah, I agree. And then I just wanted to pop up this chart. This is the 10-year, and obviously we're talking about interest rates here. And one of the things on the 10-year that's interesting is right now we're stalled at a double top, right? So this is a classic double top going back to the high from October. Obviously, what I think is amazing here is that the October high coincided with the lows of the stock market back in October 2022. Here we are back at those, and the stock market's way higher, right? Now, granted, that's probably mostly just a group of stocks we know about. But if we do break up, there's this longer term trend line here that takes you to about 4.58, 4.6% on the 10-year. And so basically what I would say is if we break through this 4.33 level, then that would be your target, which would be around 4.56. And that kind of, in a way, would coincide with another 1 to 2 rate hikes from the Fed, I would guess, if we were to get that. So just a little interesting action there on the 10-year yield.
I was looking at the 10-year yield and kind of seeing that breakout and wondering if it's going to break higher, but I don't know. I mean, the longer that the markets kind of remain weak, and Powell just keeps saying this thing, I mean, at some point you expect it to just keep breaking high. I mean, there's only so much that it can take before they finally believe what he says. And that's the issue, is the markets haven't really believed Powell for a long time. That he's going to do what he says. And another metric, because you just mentioned, like, the last time the 10-year was at this level, stocks were at these lows. The last time that global net liquidity was at these levels, we can see that stocks were at their lows. And again, we've talked before about how the jaws will likely close, they'll clamp shut at some point. I honestly don't know if this is where they clamp shut or not. I mean, it's possible that they push up again and then clamp shut early next year, but this certainly, I think, does need to, the jaws will likely close at some point. And I think they'll close whenever the Fed is forced to pivot.
Yep. I agree with that. And I think I do want to just point this out, and just kind of coming full circle back to the stock market, is that I do think that a lot of the gains that we've seen in the markets have been I know there's been this narrative that it's a broad-based rally now. I'm not buying that. I want to show you guys a little chart here. This is your year-to-date index returns. So in the middle, you have the S&P, which is up 15% approximately per when this chart was made. Here's where, if you just take Meta, Amazon, Apple, Microsoft, Google, Tesla, Nvidia, up 54%. And then if you look at where the markets would be if you subtracted those 7 stocks, it would only be up 4% on the year. So for me, when I say, when I talk about how this is a market that has been led up by a small group of stocks, this chart shows just that. I mean, if you take those 7 stocks out, S&P would be up 4% on the year, which again is pretty shocking to me. It shows you how powerful the trillion-dollar companies are within the index.
If you did the same thing with crypto, I imagine we'd see something very similar, right? Like, the only reason crypto is up so much this year is because Bitcoin went up 2x. A lot of the altcoins, as you were showing earlier, right, they're actually sitting at their lows, right? Like ADA is sitting at its lows. Avalanche put in new lows.
I saw that. I saw that.
So the only reason, in the same way that the stock market is up because of the large caps, I think crypto is mainly up because of Bitcoin and Ethereum, not because of all your token altcoins that are still putting in new lows, hugging those lows, et cetera. So
So
Yeah, I
true.
think it's across the board. It's really across the board.
So true, so true. So before we close out, I just wanted to quickly go over maybe some commodity charts out there for people, and anything else you have on your docket there, Ben. But I do want to just point out that I continue to keep a close eye on gold here. I continue to be a fan of gold, and by the way, I'm a huge long-term fan of Bitcoin as well. I think it's going to be the digital gold of the future, but right now it's not, and that means something to me here. But look at this tightening wedge pattern in gold right now. Gold again bounced off this low trend line, putting in a little bullish consolidation. If it can break through this 1940 level, you could test about 1987, 1988. And then you got your triple top, and triple tops, guys. In general, if you look at probabilities show us that when you have 3 hits, it's hard for something to break out. By the 4th hit, you're getting much more higher probabilities of a breakout coming, which if we went up there, this would be the 4th hit. So I think gold is an interesting chart. I know silver, a lot of you guys out there love your silver. Silver has had a very big rally into resistance here. It still has to get through these couple levels, but the bigger one is the yellow trend line. If it can get through that level, it's off to the races. I'm more bullish on gold than silver because of the industrial component of silver. Silver is used in a lot of industrial production. So if the economy does end up slowing, it probably takes a little away from that versus gold is the pure play. But yeah, I mean, I think that the commodity wise, it's things are interesting right now with especially with the strength in the dollar. I think it's very interesting to look at the dollar strength and then say, wow, look at how strong relative to their recent highs silver and gold have both been.
Yeah, I mean, looking at seasonality for gold in pre-election years, you can see that it does tend to climb up, especially in the latter part of the year, right? This is orange chart, or this line is 2023, and then sort of this other orangish color is more so just the average of all prior pre-election years going back to the 1980s. And yeah, I mean, from around this point, it really likes to climb higher as you get later on in the year. If we had a short-term pullback, I would be looking towards 1850 to 1860 as potential support if we even if we go that low. These longer term moving averages have provided pretty decent support in prior bull markets, and so that's where I'd be looking if we did get some type of
bigger pullback.
Yeah, like if we did get, and I don't even know if we even would. I mean, we already had a pretty massive one over here, which I think might even be just a fake out, right? Like this pullback in 2022.
Yeah,
what it just looks like to be, kind of like a fake out, maybe similar to something like this, right? Where you had a massive fake out and then it climbed back up, retested, and then sort of went up from there. So that's kind of where I am with gold. I mean, I do think we need to get back to QE at some point, and then gold should also still do well at that point.
On a technical basis, the chart you have up, it almost looks like that's a cup, and then the handle is forming right up there, cup and handle pattern too.
Right. I mean, and this still is technically, it's, these are macro higher lows. I know this is a lower low, but I think as long as you keep hanging around up here, it's only a matter of time before it likely breaks to the upside. It's not a guarantee that it does. And again, my exposure to gold generally is only about, or not maybe gold, but just precious metals in general, is only about like 5 to 7% of my entire portfolio. Just because, I sort of recognize that they can give really great gains at certain phases of the market cycle, but over the long haul, equities tend to do better than precious metals, and so that's why I've historically weighted it more into equities over more longer periods of time, just because the stock market tends to outperform. But yeah, I mean, I do think that gold is likely setting up, hopefully, for a breakout here in the coming, I would say weeks, but it moves at a snail's pace, so maybe I should say years.
Nice, man. Is there anything else like that you're seeing that you think the audience should be aware of, like whether it's in the crypto markets or the stock market or any other data out there?
Maybe the last thing to sort of say is just the we talked about apathy a bit earlier, and kind of how there's just people are really losing interest. And if you're feeling that way, there's also, we can quantify that. The social risk has gone down and put in a new low. This is related to crypto, not stocks or anything. But you can see the social risk has gone down to put in a new low here. And, just looking at like a 30-day moving average of this chart, it still has not reached the sort of the levels that it reached last time, where it went all the way, down over here. But we are getting pretty close. And remember, markets tend to bottom on apathy. Last cycle, when we sort of reached that 0.13, 0.14 area, it did not mean it was over. We still had a little, and even the 2019 move up, like we still had more to go down. But I honestly do think there is a case to be made that the altcoin market is about to enter into the depression phase where many of them put in new lows. But I actually sort of expect a lot of altcoins might actually find their bottoms in the next like 3 to 6 months is kind of what I'm thinking right now.
Do you foresee yourself as picking up some of those altcoins, or are you like, no, I just can't pick which ones are going to be the winners? Like, I mean, will you say, all right, we're in the depression phase, these things have flushed out one more time massively, let me nibble a little bit, or no?
I'm sort of looking to see what they do on their Bitcoin pairs. Like if they hold their Bitcoin pairs, then I would nibble on them. If they just keep going lower on their Bitcoin pairs, then I would probably just assume they're a relic of a prior cycle. So that's what I think people should look at. Just look at their Bitcoin pairs and kind of see. And I mean, I know we've talked about the dominance some, and again, the dominance is so this is like the 2023 year-to-date dominance chart compared to the average of 2015 and 2019. So you can kind of see that the dominance really likes to go up in pre-halving years. But remember, in the halving years, right? It's like 2020 and 2016, dominance tends to go down, at least for the first half of it. So I'm still looking for the dominance to continue to climb, probably for the rest of the year, slowly but surely. But as you get later on this year and early next year, I think the window opens for the altcoin market, and I'm sort of looking for it to correspond to a similar time where you might see the unemployment rate start to go up. And the Fed is forced to ultimately pivot. Like the Fed could pivot in 2024, right? Like I think there's a good chance they will, and that could mark the bottom on altcoins. As we showed earlier, right? They're dependent on excess liquidity. So the minute liquidity comes back, that's where altcoins start to shine again. I still think it's a little bit too premature right now, but it should be coming.
Last question I have for you, that you brought up the last chart that showed the apathy, kind of this disinterest. We see it making a new low, kind of. Yet price on Bitcoin, at least Bitcoin specifically, is at not a new low. Is that would you refer to that as a positive divergence in Bitcoin, or that doesn't really have some impact?
So I've sort of thought about it as like social divergence, where like price is going up, but social risk is going down. There was a period over here where we saw price sort of slowly, I mean, this was sort of slightly going up and the social risk was going down, and then the entire market just dropped like 50%. And the other thing, Gareth, that I constantly remind myself of when people start talking about the halving, and the only reason I really sort of point this out is because I've sort of been on the not prepared side in the past for it. And so what often we see after sort of a pre-halving year rally before the real rally is we see about a 50% drop, right? I mean, so like 2015 was a 50% drop before the halving. Even if you exclude the sort of the pandemic drop over here, and you just take it from this high to the end of 2019, that's still about a 55% drop, right? So it's really, and even over here in 2011, right? I mean, from August to 2011, you had a 70% drop before the halving actually occurred. So I still think that that Bitcoin likely will get a continued shakeout before the halving, because that's what normally happens. We talk about the halving, and instead of people getting excited about it, the price of Bitcoin halves, and then we say, all right, that's what people meant by the halving, and then sometime after the halving, we actually have a more realistic chance of going up higher, right? I don't really think that Bitcoin's going to be going to 40 or 50K this year, which, I mean, if people watch your channel, they watch my channel, they certainly are not getting that idea. But if you go onto Twitter, a lot of people are calling for that. A lot of people are still calling for Bitcoin to surge back up here at the end of the year. But, I just don't see it. I think it's likely going to fade here with some lower highs until we get maybe by the end of the year, early next year.
No, I agree, man. That's amazing. So on that note, I think we say the end is here for us, and we step aside for the week. But I do want to say that, as always, Ben, you bring amazing insights to the market, and follow Ben, guys. Follow him on Twitter. Follow him on YouTube. Check out his service. What's the website? Is it intothecryptoverse.com?
Yeah.
Beautiful.
Yeah.
So follow him there, guys, and we appreciate each and every one of you. I always like to say that, guys, because we do see the comments, the positive comments, and you guys can share it with friends and family. It means the world to us. Our goal is to give you guys the non-biased kind of, this is the facts. And sometimes we don't like the facts, frankly. I understand that, but it's better to know than to not know and get caught with your pants down, as they say, right? So, yeah, I think that's all I have. Ben, anything else to add?
Yeah, just echo same thing, guys. Garrett's socials are in the description below. His website, inthemoneystocks.com, and you can find all that stuff down in the description below. Make sure you check it out. He offers a lot of great services and just insight, I think, into the market. And the great thing about it is, you know, it's data focused, and I think that's where we want to be, right? We want to be data focused. It doesn't mean we're going to get everything right or anything like that, but as long as you're coming at it with like a good mind, I think you're going to be more successful over the long haul.
Absolutely. All right, guys, you guys have a wonderful rest of your day and your week, and we'll see you next Monday at 11 o'clock.